Today, we are looking at differential analysis, the keys to decision making. And this kind of goes along with what we've been looking at. So, making decisions is one of the basic functions of a manager. To be successful in decision making, managers must be able to perform differential analysis, which focuses on identifying the costs and benefits that differ between alternatives. The purpose of this chapter is to develop these skills by illustrating their use in a wide range of decision-making situations. Okay, so again, chapter 13, differential analysis, key to decision-making. And first of all, we'll talk about some relevant and irrelevant costs and benefits in a decision. So key concept one is that every decision involves choosing from among at least two alternatives. Therefore, the first step in decision making is to define the alternatives that are being considered. Key concept number two. Once you have defined the alternatives, you need to identify the criteria for choosing them. Relevant costs and relevant benefits should be considered when making decisions. Irrelevant costs and irrelevant benefits should be ignored when making decisions. Okay, key concept number three. The key to effective decision making is differential analysis, focusing on the future costs and benefits that differ between the alternatives. Everything else is irrelevant and should be ignored. A future cost that differs between two different alternatives is known as a differential cost. Future revenues that differ between any two alternatives are known as differential revenue. An incremental cost is an increase in cost between two alternatives. An avoidable cost is a cost that can be eliminated by choosing one alternative over another. All right, concept four. Sunk costs are always irrelevant when choosing among alternatives. And a sunk cost is a cost that has already been incurred and cannot be changed regardless of what the manager decides to do. So again, a sunk cost is one, it's already been paid, it's not going to make a difference regardless of what alternative you choose. And then key concept number five. Future costs and benefits that do not differ between alternatives are irrelevant to the decision-making process. So something that isn't going to change isn't going to become a factor in your decision-making. Key concept number six, opportunity costs are also need to be considered when making decisions. And remember that an opportunity cost is the potential benefit that would be given up when one alternative selected over another. So you choose one alternative or the other. If so it's whatever the benefit is, you give up that benefit by choosing another alternative. Okay, so some examples of relevant costs and benefits. So the management of a company is considering a new labor saving machine that rents for $3,000 per year. Data from the company's annual sales and costs with and without the new machine are shown. Notice that the total approach requires constructing two contribution margin income statements and one for each scenario. And we've done that. Now, the difference between the two income statements is $12,000 equals the differential benefits shown at the bottom of the right-hand column. The most effective means of analyzing this decision is to use the differential approach to isolate the relevant costs and benefits as shown. So we see that with the new machine, they would make 12,000 more in Well, no. So the decrease in direct labor cost, but the increase in the fixed rental expense, and then that gets us the financial advantage of doing the machine now. So using the differential approach is desirable for two reasons. Only rarely will enough information be available to prepare detailed income statements for both alternatives. Mingling irrelevant costs with relevant costs may cause confusion and distract attention away from the information that is really critical. So learning objective number 2 is to prepare an analysis showing whether a product line or a product segment should be added or dropped. And one of the most important decisions that managers will make is whether to add or to drop a business segment. Ultimately, a decision to drop an old segment or to add a new one is going to hinge primarily on its financial impact. To assess this impact, it is necessary to carefully analyze the costs. And we're going to look at an example now. So due to declining popularity of digital watches, Low Company's digital watch line has not reported a profit for several years. Lavelle is considering whether to keep this line or drop it. So to determine how dropping this line would affect the profits of the company, Lavelle will compare the contribution margin that would be lost to the costs that would be avoided if the line was to be dropped. So the decision rule then would be that they should drop the digital watch segment only if by doing so its profits would increase. Lavelle will compare the contribution margin that would be lost if the digital watch line was discontinued to the fixed expenses that would be avoided if the line was discontinued. So assume a segmented income statement for the digital watch line is as shown. Also assume the following that we'll go over in a minute. So we see here that they're running at $100,000 net loss. So an investigation has revealed that the fixed general factory overhead and the fixed general administrative expenses would not be affected by dropping the digital watch line. So the fixed general factory overhead and the fixed general administrative expenses, they would stay the same regardless if we drop this line. So they're not going to be relevant in our decision making. Also, the equipment used to manufacture digital watches has no resale value or alternative use. So they aren't going to be able to repurpose this equipment for something else or to sell it. So what do you think they should do? So a contribution margin approach reveals that the contribution margin lost 300,000 exceeds the fixed cost avoided 260,000 by $40,000. Therefore, Lavelle should retain the digital watch segment because even though that particular segment is losing money, it is contributing to the overall of the company. Okay, learning objective 3 is identify relevant costs and benefits associated with sourcing decisions. So again, some key terms in related to strategic to sourcing and strategic aspects of sourcing. When a company is involved in more than one activity in the entire value chain, it is said to be vertically integrated. A decision to carry out one of the activities in the value chain internally rather than to buy externally from a supplier is called a make or buy decision. So you might decide to make a component or you might decide to buy a component from someone else. So those are decisions that manufacturers will quite frequently have to make. Now, Some critics charge that managers have habitually based make or buy decisions on per unit data without determining which costs are relevant and which are not, since the per unit cost typically includes allocated common fixed costs. They overstate the cost of producing internally. This creates a bias in favor of outsourcing production. So vertical integration, it provides certain advantages. And so a vertically integrated company may be able to ensure a smoother flow of parts and materials from production than a non-integrated one, because again, it's all going to be done internally within the organization. Some companies feel that they can control quality better by producing their own parts and materials. Integrated companies realize profits from the parts and materials that they choose to make instead of buy. But the primary disadvantage of vertical integration is that the company may fail to take advantage of suppliers who can create an economies of scale advantage by pooling demand from various companies. And so while the economics of scale factor can be appealing, a company must be careful to retain control over activities that are essential to maintaining its competitive performance. So for example, if you think about an automobile, and let's say Ford, and they're making trucks, they could choose to make the seats that go inside the truck themselves, or they could choose to buy them. And again, if they were to buy them, then they would have to think, well, maybe they could have smoother flow and get them where they need them, have better control over the quality, possibly, and in so doing, maybe realize profit over and reduce cost over if they were to purchase them. But again, by they themselves, even though they're a very large company, they may not have economies of scale. So they will purchase from another company that also makes them for Dodge, for GMC, for GM, for all these other companies. So then they're able to take advantage of there's an economies of scale of buying from a company that makes them for everyone else, because that in of itself can actually reduce costs to a certain extent. So we'll look at an example. So sourcing decisions, an example. Assume that Essex company currently manufactures part 4A with a unit product cost as shown. So the product cost is $30 for that part. Now, please also assume the following information as shown in respect to part A, 4A. Given these additional assumptions, should Essex stop making part 4A or buy from an outside supplier? And we'll take a look at that. So they also have that the special equipment used to manufacture the part has no resale value. The amount of the factory overhead, which is allocated on the basis of direct labor hours, would be unaffected. The $30 per unit price is based on 200,000 cubic parts produced each year. An outside supplier would provide 20,000 parts at a cost of $25 per part. So should they make the part or buy it? And we see here, if they were to do that, $25, it would be $500,000, and they wouldn't have the other costs for the direct materials, 180,000 in direct materials, 100,000 in direct labor, 20,000 in overhead, so on and so forth. We said a couple of these things, they're unavoidable, so we wouldn't include them in our decision. So the unavoidable costs associated with making part 4A include direct materials, direct labor, variable overhead, and salary. Now notice that the depreciation of special equipment is irrelevant. The cost incurred to buy the equipment is a sunk cost because, again, we've already bought the equipment. The depreciation simply spreads that sunk cost over the equipment's useful life. Therefore, the equipment has no resale value, or furthermore, it has no resale value. Thus, the special equipment and its associated depreciation expense is irrelevant. The allocated general factory overhead represents allocated costs common to all items produced in the factory and would continue unchanged even if part 4A would be purchased from an outside supplier. Thus, the general factory overhead is also irrelevant. Okay. So the financial advantage of making the part is 160,000 less than the cost of buying the part, thereby suggesting that Essex should continue to make the part. So they would actually save 160,000 by going ahead and just continuing to make this part. Now, opportunity costs are not recorded in the organization general ledger because they don't represent actual dollar outlays. Rather, they represent economic benefits that are foregone by the result of pursuing some course of action. In the Essex Company example we just completed, if the space now could be used that's now used to produce part 4A would otherwise be idle, then the company should continue to make their own parts and the supplier's offer should be rejected. Idle space has no alternative use, has an opportunity cost of 0. So if the space to make part 4A had an alternative use, the opportunity cost would have been equal to the segment margin that could have been derived from the best alternative use of this space. So, if they're just going to leave it idle, then that's not good. But if they, the opportunity cost, if they were going to put something else there, then we would have to consider that. Okay. Learning objective 4 is preparing an analysis showing whether special orders should be accepted. So a special order is a one-time order that is not considered part of the company's normal ongoing business. And when analyzing a special order, only the incremental costs and benefits are relevant, since the existing fixed manufacturing overhead costs would not be affected by the order. They are not relevant. So again, remember the incremental concept in decision making. If a company accepts a special order to produce an item without carefully determining existing capacity, it might have to cut into regular production. The effects of lost sales from ongoing products might be devastating. So we'll look at Jet Inc. next. Okay, example. So we'll assume the following information with respect to a special order opportunity from Jet Inc. Should we accept the offer? So Jet Inc. makes a single product whose normal selling price is $20 per unit. A foreign distributor offers to purchase 3,000 units for $10 per unit. This is a one-time order that would not affect the company's regular business. Annual capacity is 10,000 units, but Jet Inc. is currently producing and selling only 5,000 units. So should Jet accept the offer? Okay. So a contribution margin in format income statement for Jet Inc.'s normal sales of the 5,000 units is shown. And it's showing that their variable cost was 8. Now, if Jet accepts the special order, the incremental revenue of 30,000 will exceed the incremental cost of 24,000 by 6,000. This suggests that Jet should accept the order. Now, notice that this answer assumes that the fixed costs are unavoidable and that variable marketing costs must be incurred on the order. Okay, so we'll do a quick check. So Northern Optical ordinarily sells the X lenses for $50. The variable production cost is 10. The fixed production cost is $18 per unit, and the variable selling cost is $1. A customer has requested a special order of 10,000 units of the X lenses to be imprinted with the customer logo. This special order would not involve any selling costs, but Northern Optical would have to purchase an imprinting machine for $50,000. So, what is the rock bottom minimum price below which Northern Optical should not go in negotiations with this customer? In other words, below what price should Northern Optical actually would they actually be losing money on the sale? There is ample idle capacity to fulfill the order and the imprinting machine has no further use after this order. So it would be the cost per each pair of glasses would be $15. So you have the variable production cost of 100,000 plus the additional fixed, which is 50,000 for this machine, is 150, and then the total units is 10,000. If we divide that 10,000 into 150,000, then we get $15. So we'll look at volume trade-off decisions. Now, companies are forced to make volume trade-off decisions when they do not have enough capacity to produce all of the products and sales volume demanding by the customers. In these situations, companies must trade off or significance production of some products in favor of others in an effort to maximize profits. When a limited resource of some type restricts the company's ability to satisfy demand, the company process that is limited overall output, or the company is said to have a restraint. The machine or the process that what's causing the restraint would be called a bottleneck, or the restraint would be called bottleneck. Yeah, this is a restraint. That's common. So again, a production process can be thought of as a chain. Each link in the chain represents a step in the link, or a step in the process. A link is only as strong as the weakest link. Likewise, the capacity of a production process is determined by its weakest link, which is the constraint. To increase the strength of a chain, its weakest link must be strengthened. To increase the output of the entire process, the output of the constraint must be increased. Strengthening the stronger links has no effect on the strength of the entire chain. So strengthening the stronger chain has no effect on strengthening the chain. The moral is to identify the constraint and concentrate management attention on effectively increasing its capacity. And so now we're going to look at what would be the most profitable use of a constrained resource. So fixed costs are usually unaffected in these situations. So the product mix that maximizes the company's total contribution margin should be ordinarily selected. A company should not necessarily promote those products that have the highest contribution margins. Rather, total contribution margin will be maximized by promoting those products or accepting those orders that provide the highest contribution margin in relation to the constrained resource. And so again, looking at this utilization of a constrained resource. So assume the Ensign company produces two products and the selected data are shown here. So machine A, which is a constant production, there is excess capacity on all the other machines. Machine AI, or excuse me, machine A1 has a capacity of 2,400 bottles per week. Ensign is trying to decide if the double, or is trying to decide if it should focus its efforts on products 1 or 2. And we'll go over that in a little more detail here. Okay. So machine A1 is a constrained resource that is being used at 100% capacity. There is excess capacity on all the other machines. Machine A1 has a capacity of 2,400 minutes per week. Should Ensign focus its efforts on product 1 and 2? So based on that, how many units of each product can be processed through machine A1 in 1 minute? 2 units, because it takes, so we just divide that and we can work that out. And what generates more profit for the company? Using 1 minute of machine A to process product 1, or using 1 minute of machine A to process product 2, and it would be product 2. Because with 1 minute of machine A, Ensign could make 1 unit of volume 1 with a contribution margin of $24, or they could make 2 units of product B, which has a contribution margin of $15 per unit. So it doesn't contribute as much. So we see here that 2 times 15 equals 30, which is more than 24. So better off to do make 2 products instead of 1. Okay. So as suggested by the answer to the quick check questions, Ensign should emphasize product 2 because it generates a contribution margin of $30 per minute of the constrained resource relevant to $24 per minute for product 1. Ensign can maximize its contribution margin by first producing product 2 to meet customer demand, and then using any remaining capacity to produce product 1. The calculations would be performed as follows. So satisfying the weekly demand of 2,200 units of product 2 would consume 1,100 minutes of available capacity on machine A1. This implies that 1,300 constrained minutes would still be available to satisfy demand product 1. Since each unit of product 1 requires 1 minute of AI machine time, Einstein could produce 1,300 units of product one with remaining capacity. This mix of production 2,200 units of product two and 1,300 units of product one would yield a total contribution margin of 64,200. All right, so learning objective 6. Determine the value of obtaining more of the constrained resource. How much should Ensign be willing to pay for an additional minute of A1 machine time? Because the additional machine time would be used to make more products of Unit 1, Ensign could be willing to pay up to $24 per minute. This amount equals the contribution margin per minute of the machine time that would be earned producing more than one product. So let's do another. Okay. So Colonial Heritage makes reproduction colonial furniture from select hardwoods. The company's supplier of hardwood will only be able to produce 2,000 board feet this month. Is that enough of the demand? We have to do some arithmetic there to find out. And it's not, because 2 times 600 plus 10 times 100 is 2,200, which is greater than 2,000. Okay. And the company's supplier of hardwood would only be able to produce 2,000 board feet this month. What plan would be to maximize profits based on the information here? So it'd be to produce 600 tables and 600 chairs and 80 tables. So again, you have the selling price of each one listed there. You have your contribution margin listed there. So 600 chairs and 80 tables. Now, as before, Colonial Heritage's supplier of hardwood will only be able to supply 2,000 board feet this month. Assume the company follows the plan we have proposed. Up to how much should Colonial Heritage be willing to pay above the usual price to obtain more hardwood? $20 per board feet. The additional wood would be used to make tables. In this case, each yeah. But anyway, they would be $20. So the additional wood would be used to make tables. In this case, each board foot of additional wood would allow the company to earn an additional $20 of contribution margin and profit. Okay. Now, managing constraints. Now, it is often possible for a manager to increase the capacity of a bottleneck, which is called relaxing or elevating the constraint in numerous ways, such as working overtime on the bottleneck, subcontracting some of the processing time or processing that would be done at the bottleneck, investing in additional washing machines. Wow. Additional machines at the bottleneck. Shifting workers from non-bottleneck processes to the bottleneck. focusing business process improvement efforts on the bottleneck, reducing the effective units processed through the bottleneck. Okay. So joint product costs and sell and process further decisions. All right, so some key terms and concepts. In some industries, a number of end products are produced from a single raw material input. When two or more products are produced from a common input, these products are known as joint products. The split off point is the point that is the manufacturing process at which the joint products can be recognized as separate products. For example, in the petroleum refining industry, a large number of products are extracted from crude oil, including gasoline, jet fuel, heating oil, lubricants, asphalt, and various organic chemicals. The term joint cost is used to describe costs incurred up to the split-off point. Joint costs are incurred often to simultaneously produce a variety of end products. Okay, so joint costs are traditionally allocated among different products at the split-off point. A typical approach is to allocate joint costs according to the relevant sales value of the end products. Although allocation is needed for some purposes, such as balance sheet inventory valuation, allocations of this kind are very dangerous for decision making. Sell or process chemical. So joint costs are relevant to decision making regarding what to do with a product from the spin-off point forward. Therefore, these costs should not be allocated to end products for decision making purposes. With respect to sell or process further decisions, it is profitable to continue processing a joint product after the split-off point, so long as the incremental revenue from such processing exceeds the incremental processing costs incurred after the split-off point. And so we'll look at an example. So Sawmill Inc. cuts logs from which unfinished lumber and sawdust are an immediate joint products. Unfinished lumber is sold as is or processed further into finished lumber. Sawdust can be sold as is to gardening wholesalers or processed into presto logs. So sell or process further decisions. Joint costs are irrelevant in decisions regarding what to do with a product from the split-off point forward. Therefore, these costs should not be allocated to end products for decision-making purposes. With respect to sell or process further decisions, it is profitable to consider processing a joint product after the split-off point, so long as the incremental revenue from such processing exceeds the incremental processing costs incurred after the split-off point. So assume the following facts with respect to Sawmill Inc. Sawmill has two joint products, lumber and sawdust. Selected financial information is shown for each joint product. The incremental revenue from further processing of the lumber into sawdust and sawdust is $130 and $10 respectively. The financial disadvantage of further processing is $80 for the lumber and minus $10 for the sawdust. The lumber should be processed further, and the sawdust should be sold at the split off point. Okay. Okay, good. This is the last page. Okay, and then activity-based costing and relevant costs. Activity-based costing can be used to help identify potential relevant costs for decision-making purposes. However, managers should exercise caution against reading more into this traceability than really exists. People often assume that if a cost is traceable to a segment, then the cost is automatically avoidable, which is untrue. Before making a decision, managers must decide which of the profitable potential relevant costs are actually avoidable.